Hello everyone! When it comes to investing in the stock market, one of my core principles is to find and acquire stocks that are trading below their true value. This naturally leads to a common question: how can we determine the actual worth of a stock, especially when dealing with giants like Apple and Facebook? Today, I want to explore precisely that topic. We'll dive into a method I use to evaluate companies and identify if they are selling at a significant discount to their intrinsic value. Of course, I only consider adding them to my portfolio if they align with my positive outlook on the company's future prospects. So let's get started. If you find value in today's discussion, please hit the like button and subscribe for more content. Now, without further delay, let's explore the process of valuing stocks. 1. Apple stock valuation example. Today, our case study revolves around Apple, a company well known for being Warren Buffett's flagship investment at Berkshire Hathaway. This will help illustrate how I arrive at the per-share valuation for Apple, using a method inspired by renowned investor Phil Town. This approach, which you can find in his books like Rule Number 1 and collaborations like Payback Time, forms the core of our discussion. 2. Key metrics for valuation. To start, we need specific data. First, we'll gather the earnings per share for the trailing 12 months, EPS TTM. A convenient source for this data is Yahoo Finance, which currently lists Apple's EPS TTM at $11.89. 3. Growth rate and return date. Next, we factor in a projected growth rate for Apple's earnings over the next 10 years. This growth estimate often comes from analyst forecasts. For today's exercise, we'll go with a consensus rate of 12% per year. Additionally, we select a minimum acceptable rate of return, which for this demonstration, I'll set at 15%. This rate compensates for the risk associated with stock investing and aims for returns that exceed the broader market index. Number 4. Margin of safety. A fundamental principle in value investing is the margin of safety, which means buying stocks at a price significantly below their intrinsic value. Here, I'll apply a 50% margin of safety, providing a conservative buffer against potential errors in our valuation. 5. Price to earnings, or PE ratio. The PE ratio tells us how much investors are willing to pay for a company's earnings. We'll use an average of historical PE ratios to forecast future selling prices. In this case, the average PE ratio is 24. 6. Future earnings calculation. With these metrics in hand, we can project Apple's earnings over the next 10 years. Assuming a 12% growth rate, we estimate future earnings and then multiply them by the chosen PE ratio to calculate the share price a decade from now. 7. Valuation backwards calculation. To find the current purchase price that aligns with our 50% return rate, we perform a reverse calculation. Starting from the estimated future value, we discount it year by year using our 15% rate to arrive at the value that corresponds to our current target return. Based on these calculations and taking into account the 50% margin of safety, we arrive at a fair valuation of $145 per share for Apple. However, keep in mind that as value investors, we aim to purchase stocks below their calculated value. Therefore, our target purchase price, including a margin of safety, becomes $72.50 per share. This is the price at which we could consider buying Apple stock.